First of all, central banks have a terrible track record at preventing recessions. I believe strongly that what's happening today is that central banks are panicking.
Please join us for our next live stream Sunday, March 29 at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, March 29, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to this channel or you have not already done so, please do subscribe. Click on the bell to be notified on new updates and give us a thumbs up if you like what we do. We really do appreciate your support. Our guest today, Tavi Costa, Global Macro Analyst at Crescat Capital, an asset management company that capitalizes on the most compelling macro themes to grow and protect wealth. His research has been frequently featured in financial publications such as Bloomberg and the Wall Street Journal, and we are delighted to have him here back again as a return guest. Good day, Tavi, and welcome back to SBTV. How are you doing?
I'm great, Patrick. Great to talk to you again and great to be here again.
Agreed. Good to see you again, and thanks for giving us the time. I read the Crescat Capital Quarterly Investor Letter, Q4 2019, recently, and it opened with the sentence, "The bear case for U.S. stocks has never been stronger." And it goes on to say that the business cycle is poised to turn down and that it's timely for investors to be aware of the gravity of the situation today. Tavi, how grave is the situation for U.S. stocks, and should investors be concerned only with stocks, or are there other assets that are also severely overvalued?
That's a good question. I know we've been saying this for some time, and a lot of it has actually materialized, especially on the macro side of indicators overall in the world have been deteriorating. We had a macro model that looks at 16 factors to kind of combine not just technicals, but macro indicators and fundamentals of companies that really helped us to identify that we're really late in the cycle. But it kind of was a mix with things like the yield curve inversion that happened in August of last year, that we had close to 70% of the yield curve got inverted.
Right.
That was a big deal, a big signal that every single time we reached that 70% handle, we've had a recession follow. But more recently, I think you always need a trigger for things to really start working in our favor, especially on the downside. The virus perhaps was a big trigger, and I think it's something that central banks can't really fight the way they have been fighting other issues we had in the past. And you can kind of see a lot of movements in the markets overall, like the credit markets, especially 10-year yields. When you look at the year-over-year change of 10-year yield, has never been as low as it is today. It's a record low, not just on the 10-year yield itself. I'm talking about the year-over-year change. And when you compare that type of change, it usually happens when you were at the peak of the cycle. You had copper also collapsing and breaking an incredible support since '08. You had oil doing the same. But even before the virus, I mean, we've had this massive distortion between prices of risk-on assets overall versus fundamentals, not just in the private equity industry, but also in the public markets, in the stocks here in the U.S. mainly. If you looked at earnings for companies in general, they've been contracting. They have not been growing like a lot of people have been saying. And the only V curve sort of recovery that we had so far has not been in fundamentals, has been on the Fed balance sheet that has been actually increasing as we see those deteriorations in not just macro but fundamentals as well. But one thing that held up very well last year was labor market and the consumer confidence, which I think that's about to change. I think if you ask me, I think there's a high probability that unemployment rate that has on a year-over-year change still being declining. I think that's going to actually start increasing, and that will be really the end of the cycle in my view. I think that with the virus, the impacts from the virus, it's going to be very hard to hold up this very complacent market with consumer confidence basically at record highs. And when you look at things like not just the labor market starting to crack, the continuing jobless claims is starting to rise on a year-over-year basis, the earnings contraction, which is if companies are making less money, they're probably not going to be hiring as much, and you have just job openings beginning to collapse. So we've been noting that for the last few months already. It's the biggest decline since the global financial crisis already. So putting all together, I truly believe that this virus really looks to be the last nail in the coffin for record overvalued stocks and the economy at a very late stage here at the cycle.
Yeah, completely agree. I'm sure we'll touch on the virus in a bit. When you said a V curve, I'm flipping through my mental Rolodex. Where's the V curve? Only V curve I saw also was the Fed balance sheet. So
exactly,
we're on the same page there. But with the Fed, former Dallas Fed President Richard Fisher, he said recently that the market has become too dependent on the Fed to save it from turmoil. And even other guests on our show, they've also said the same thing, that the Fed safety net is causing investors to even front run the Fed supportive actions. Do you agree with this view that the U.S. stocks can only sustain their current levels only because of Fed's intervention?
Yes, but I also disagree with the idea that the market cannot turn because of the Fed intervention or central banks in general. It's important to remember that back in '08, or really before that, '07 and '08, the ECB printed close to $1.7 trillion of money prior to the Great Recession. You had the same happening with the BOJ. It was close to 600 billion. 400 billion was completely before the market began to crash. And then after that, when things begin to derail, that's when you have another $200 billion of money printing from the BOJ. And Japan is a great way to kind of see this, in my view, almost stupid reliance on ridiculous reliance on central banks that they are able to prevent the cycle from turning. When you look at Japan for the last 2 decades, you have their 10-year yields in average was below 2%. That never prevented them from having 2 drawdowns of 60% in stocks and 6 recessions. And it's important to remember that the valuations of Japanese companies are not even close to valuations here in the U.S. So when you have this, especially now with the virus, which again is something that central banks can't really control as much as they can control other things. Sure, that it can delay the issue, but I don't believe. I think that this movement from central banks in general just gives more conviction in my thesis on gold, which I think it's more and more becoming a hedge against not just those interventions, but also the equity markets. If you look at like the gold to S&P 500 ratio or gold versus stocks in general, it continues to rise. Regardless if it is because of one part of the trade, which is gold rising or outpacing perhaps stocks, or just stocks starting to collapse like we had last week. And I think that the 2 parts of that trade are going to start working ultimately, because I truly believe that, first of all, central banks have a terrible track record at preventing recessions. Never done that before. All we were seeing is just more extreme policies since 1990s and so forth. And I believe strongly that what's happening today is that central banks are panicking. We had close to $470 billion already printed in the last 20 days. From the ECB and the BOJ. I mean, that's a big deal. At the same time, you had the Fed and the BOC, or the Bank of Canada, cutting interest rates by 50 basis points in the same month. No one that was the last time that happened. That was all in the tech bust and the housing bust. In other words, it was all in 2001 and 2008. I think this time is no different, and I believe strongly, just because of that distortion of prices and fundamentals and distortion of prices and macro indicators. It's only getting worse, and I think with the virus situation, it's not going to get any better. It's actually going to get a lot worse. Look what's going on in China as just an example of what's going on.
Yeah, you touched on how the Fed seems to be in the markets and such. But do you view this as blatant market manipulation? And how can investors navigate through this environment where the signals seem to be distorted or even crossed at times?
Yeah, again, I think that central banks won't be able to prevent the cycle from turning. And I think it's important to notice a few differences. I mean, it's never going to imbalances will never unfold in the same way that they did. I don't want to fight the last war in the number one. I think there's a lot of fears from owning gold as a hedge because of what happened in sometimes in mid and late '08 with gold and miners actually getting crushed. But it's important to note the difference, especially from the equities to commodity ratio. When you looked at that throughout history, very different in '08. I mean, we have there a situation that looks a lot like 2000 in 1973, 74, and in which gold actually served as an incredible hedge back in those days. But more importantly is really the empirical analysis of things like yield curve inversions, which is hard to find. In our view, I think it's important to go back in history and look at all the macro indicators that actually coincide or preceded previous recessions and downturns in the cycle. And yield curve is an incredible one because it does have a perfect track record at predicting recessions. And when you looked at that, every time we reach that 70% handle, it's not just important to note that it also preceded recessions, but also what are the best investments that work during those periods. And actually is gold to S&P 500 ratio. So when you look at that ratio, historically, it tends to actually double in the next 2 years as that works and as develops, and then the market begins to fall apart. I think that's kind of what we're seeing today. I mean, gold is really starting to disconnect from the S&P. The S&P was holding up pretty well, and now it's starting to fall apart. I believe strongly. We just had a Dow theory bear signal recently, which is a big deal in the technical standpoint. With all the commodities falling apart, I find it very difficult that the central banks will be able to control equity markets from a mean reversion of multiples in general. And when you look at that in terms of valuations, I mean, we're looking at a 55% or so decline to go back to the mean historical mean valuations we've had in the past. I mean, it's insane. So I mean, it's just more reason to look for alternatives of investments in terms of hedges. And I think that precious metals is perhaps one of them that truly looks as a real form of protection.
Yeah, let me ask you a question about that. You mentioned gold breaking away from the S&P. How about the paper price? You think gold and silver will ever break away from their paper price, or the physical can actually break away from the paper price?
That's a good question. And I believe I'm not so much in that camp that we have to hold, let's say physical gold in general because the world's going to end or anything like that. I just believe in a normal downturn in the cycle that will cause, safe havens, true safe havens to rise and risk-on assets to fall apart. There's so many reasons why you want to be owning gold today, regardless. And if any precious metals is another one that is linked to gold prices, and it's historically cheap. So when you find those sort of setups, it's where I find it more interesting. It's important that what we have today here is a global synchronized debasement. Anybody here can go and look at gold prices against any other currency in the world. Gold prices have been rising in any currency you look at, especially currencies like China, Brazilian real. So emerging markets are already signaling that debasement situation that we've been seeing. It's not global synchronized growth that people used to call back in 2017. It's the debasement is the issue. And, especially at times when you have the entire treasury curve below inflation, that never happened before. Actually, I should say that happened in 2016, but the big difference was that in 2016, the Fed was tightening. This time we're easing in a big way, not just in the US, but globally. So I believe strongly that that it's that is more important than anything else is the fact that regardless, I'm not sure, not in the camp that the world's going to end. I'm in the camp that we need a typical downturn in the cycle and reset the financial system overall.
But when we last spoke with you in June 2019, the duration of the current U.S. business cycle just reached a new record. And today, as we were sort of discussing, there's a whole list of zombie businesses right now going on. How long more can this, in your opinion, do you think this can keep on going? And how do you factor in the seemingly unending longevity of the business cycle in your economic forecasts?
Yeah, that's difficult. It is the longest business cycle in history, and it's not easy because bull markets don't die of age, and I understand that point of view very well. And it's obviously we had some sort of slowdown recovery from the global financial crisis in terms of GDP growth, but not in terms of assets. Assets have gone basically parabolic if you think about it, especially equities in the U.S. And it's interesting how distorted they were from fundamentals. I mean, earnings are not growing; they're actually contracting. And it's when you look at things like corporate spreads, have never been so low, or junk bonds and yields have never been so low. Investment graded bonds never been so low. The negative yielding bonds. I mean, it's like you have this entire setup that looks. And no, everyone is ignoring the fact that equities continue to move higher, and they're just relying the central banks to continue to hold investors' hands. And in our view, that is probably the best setup in my career, and I'm sure Kevin's my partner career as well. And I think it's in terms of valuations. I mean, come on, this is much worse than 2000. In 2000, for instance, a lot of the overvalued stocks are mostly in the tech industry. Some telecommunication stocks are also very overvalued. But today what we have is that equities are historically overvalued, at least in 8 fundamental factors. And when you looked at our favorite metric like EV to sales, I mean, it's almost twice the size, the median EV to sales, so not aggregate. It's almost twice worse as it was in 2000, right at the peak of the tech bubble. And when you looked at the breadth of the market overall, I mean, it never been so frothy. And you have close to 8 sectors out of 11 sectors in the S&P 500 are historically overvalued. So I think that unfortunately for pension funds, for investors on the long term, this is going to be a very bad time to be invested in equity markets, in my view. And I believe strongly that commodities have not industrial commodities, more precious metals are looking a lot more attractive than risk-on assets in a lot of ways.
Yeah, I mean, being this an election year, a lot of people seem to think markets up, Trump wins, markets down, Trump loses. And so a lot of people, they start to ask the question, how real is what we are seeing as far as the markets and market movement?
Yeah, and the other important part is the more the market falls, it's self-fulfilling factor that actually hurts Trump's reelection. Market definitely is acting very crashy. I mean, that's not very normal when you have a 3% up and 3% down day pretty much every day for the last 2 weeks. And I think that that's unsustainable, and it will be proven probably that the downturn, probably the peak of the market was 2 weeks ago. And that's what we believe here. In terms of the elections, like I said, I think if I'm right in that call, it's going to be very challenging to have Trump be reelected. Trump's election really relies on a strong market, strong labor market, which has been the case, by the way, all the way to now. And now we're having a trigger. Trump can't really fight the way he has been fighting before. He can't just cut taxes and ask the Fed to cut interest rates and print more money to fix the issue of a virus outbreak. I mean, this is especially at the late stages of the cycle. Investors are beginning to wake up for the real risks that we have in the markets, and I think we're very close to some scary times, unfortunately, for risk on assets overall.
Yeah, I hear you. You mentioned taxes. Can you share with us what you observed in the U.S. pre-tax corporate profits and other indicators that you've come across that do show a different picture?
Yeah, it's important. That point is important to kind of relate to the idea of looking at things like PE ratio, because that had an impact on margins and had an impact on things like earnings. And until then, earnings were doing really great. We have margins at peak levels and all that, and that's exactly why you shouldn't be using PE ratio as a timing indicator at all. Earnings throughout history tend to look really great at the peak of the cycle. Actually works quite the same with the labor markets. Unemployment rate tends to be very low at the very end of the cycle. And I think that that is I think we're already peaked on margins here in the U.S. And unfortunately, a lot of people that rely on things like PE ratio are not are kind of missing the point. And that's exactly when you looked at PE ratios as well prior to other peaks in the market. And this is the second largest PE ratio we've had at the peak of the market prior to other peaks. All the way back to the 1800s. That's a very easy research. Anybody can just Google the Robert Shiller and it provides a PE ratio going back to the 1800s. And go back there and look at every time we peaked in the cycle and see where we are. The PE ratio today is higher than all of them but 2000. It's even higher than 1929. I believe that the PE ratio is misleading a lot of investors, unfortunately.
Yeah, you even touched on the market's 3% up, 3% down. Yield curve, it inverted and it just barely got out of it and it inverted again. What is that telling you?
Well, that's telling us that the credit market is a bit smarter given the participants that are part of the credit market. It's telling us to be cautious and telling us there's perhaps a recession coming. Like I said, the year-over-year change of 10-year yields, which doesn't have a lot to do with the yield curve inversions, but think about that conceptually for a second. If the 10-year yields is dropping like it has, I mean, it's not very normal. It's not a normal environment. The credit markets is not buying into this reliance on central banks at all, and perhaps it is kind of pricing in the idea that they're going to come in with even more QE. They're already coming in with QE. The QE from the ECB and the BOJ started even before the decline in the equity markets as we saw in the last week or so. That did not prevent the market from falling apart, and I don't think it will in the near future here. I think equity markets have reached their limit in my view. I think there's a high probability we've seen the highs for the year.
What was your thought when you saw that 10-year dip below 1%?
I think that the 10-year yield is an important indicator, but also more importantly is the fact that we have this divergence between U.S. rates versus global rates. And when you have that, I think we're starting to converge on that. That has been a trade we've been talking about for some time, especially between U.S. yields and German yields, or even U.S. yields versus Japanese yields. So the convergence between those two rates, in other words, to be more explanatory, is the fact that U.S. yields are falling faster than global rates in general. We had close to 17 economies that had 30-year yields below the overnight rates in the U.S. That sort of distortion in the credit markets is what we call the global yield curve inversion. It tends to happen every time you're at the peak of the cycle, and here we are again. It happened in 2006 and 7 and in 2000 as well. The only difference this time is that we have an unprecedented amount of countries showing that imbalance today. I think that trade has been working incredibly well, and especially because it covers you from this short-term bought situation that we had in the treasuries right now. Look at RSIs for treasuries right now; they're never been this high. Or actually been high in other times when it actually kind of marked the peak for treasuries overall, which I'm not sure. I don't think that's the case. I'm just saying when you're long treasuries and short German bonds, or you long treasuries and short JGBs or Italian bonds and so forth, that's a very attractive trade. And when you looked at those divergences on their spreads between those two global rates, almost every global rate you look at, let's just look at U.S. versus German, for instance. Every time that spread begins to converge or narrow in a big way, we're at it's another actually when they break down significantly, especially in the 5-year yield differential between U.S. and Germany. That always marked the very end of the cycle. It was actually, I believe it was March 2000 and September of 2007, the last two times those the spread really broke down from a significant support line. And it's kind of the case today. It's very close to breaking from a support line, and when it does, I think we're headed towards a recession.
Yeah, I agree. I think we're headed toward that recession too. How do you think it's going to look? And maybe more importantly, what do you think central banks are going to do when this recession hits?
I think they're already doing it. They're already panicking, and it's going to be more money printing. And it's why I think that silver and gold could even go parabolic, depending on the lack of confidence of central banks. It's very important for a shop like Crescat that is betting on the market to decline, to see the sort of market reaction that we had on days like when we cut interest rates in the U.S., which was sort of unexpected interest rate cut. At the same time, instead of the market actually rallying, it did for a few minutes, and then it started to fall apart. That is the type of reaction that you have. The investors are starting to wake up, and you do not want to be, in our view, buying the dip right now. I think that strategy has worked incredibly well for years. I don't think it's going to work well this time, especially given the circumstances of the trigger, the type of trigger that we have today, which is a trigger that no one can really fight, besides stopping consuming things and halting manufacturing plants and so forth. I think the supply disruptions from all that would be very big, and I'm not sure central banks can really do much. Like I said, I believe strongly we're in the global synchronized debasement scenario right now. This environment is extremely positive for precious metals.
Again, I agree with that. But got to ask, what happened with that huge sell-off on gold and even more so with silver the other week?
Yeah, well, that was an interesting move, and I think there's a lot of reasons for that. One of them, I believe, was, first of all, gold and silver rising significantly prior to that decline in equity markets. I think it served as a precursor of that market sell-off in equities. But also, obviously, there is some of the selling happening because of margin calls and other investments that we had, and a lot of people kind of linking that to '08. But we had sort of a short-term overbought indicators almost everywhere across precious metals. We had CFTC positioning for non-commercials hitting an extreme level, but gold itself held up pretty well, even better than silver, as you know. And at the same time, we had oil prices collapsing. So, if you think about margins for companies in the precious metals space, miners, that's great. That's an incredibly positive outlook for those companies. And I think also the link with 2008 is a little bit extreme in terms of looking at precious metals. And I'll say that because of the valuations aspect. We've been in a bear market for precious metals industry overall for a long time, and we're just starting to base out and starting to rise from those scenarios. And also, going back to the virus, I believe that the jury is still out if this is a deflationary, inflationary scenario. The market's clearly pricing in a deflationary scenario, and that's one reason why you're not seeing silver really rising as fast as gold. But who knows? What if we do have, especially from inelastic products like food, water, they have inelastic demand. People are still going to buy those products. And if you have supply disruptions, that could cause prices to rise and inflation could rise. I'm not saying, I don't think I have to make a call on inflation and deflation in terms of owning gold here because of what central banks are doing and because of how it's cheap relative to where we are in the cycle. But I think it's important to note that if we do end up having an inflationary sort of consequences from this virus, that's where I think that precious metals could go parabolic. And a lot of people are not considering that as one aspect. And the plunge in gold, let's remember the macro reasons, or from a macro perspective, the bull case for precious metals remains intact in my view. And I think that's still very positive to take advantage of that pullback and start buying some precious metals in our view.
Silver. What is the silver equities ratio showing you at the moment? Silver to equities ratio showing you?
Yeah, that 96, 95 gold to silver ratio, it's almost getting into a double top in my view. And if you look historically, all the way back to 1900s or so, so that looks very interesting for me as a trade. Also, when you looked at silver relative to equities, I put out this chart looking at silver versus the Russell 3000 total return. It looks like we just hit a perfect double bottom. Silver has been doing relative to equities, has been doing some higher lows, which technically, I love when you can combine macro fundamentals and also some technicals to give you the momentum. And looks like we just had a historic double bottom on that ratio and starting to make lower highs already in that. And I think that's going to be proven the best way. And in terms of silver, remember, silver moves fast. And a lot of times it coils up a little bit and then it starts to move in a big way. I think we could be in one of those. It looks to me like we're in a bearish flag for silver and a bullish flag for silver. And I think that could be extremely, could be looking very different in 6 months from now, in my view. But yeah, the silver to gold ratio just shows you how undervalued, historically undervalued silver is, not just against any asset in the world, but also against gold itself. And when you look at protection of or ways of protecting your portfolio, almost all investable assets today yield less than inflation. Inflation is not even high. Inflation is if you believe in CPI, I understand there's a lot of people disagree with the CPI measurements, and I think it's a valid argument. But let's just use the CPI as a very understated, in my view, way of looking at inflation. Almost every investable asset today yields less than inflation. If you looked at earnings for companies, just the growth itself, and you looked at that in real terms so you can make comparisons with precious metals, that is the worst decline in that spread since the global financial crisis. So again, just gives you another reason to own gold. And when you kind of find that early stages, or you really believe that you're at the early stages of a bull market, you want to be owning gold and precious metals and silver. Those are really gives you the higher alpha trade here for the precious metals trade overall. And then as you get into the second, third leg of that bull market in precious metals, you move towards gold as those other things may not move the same way. So I believe we're in the early stages. I truly believe that the silver could go parabolic if those virus outbreak consequences start to move in a direction that not a lot of people are seeing.
Okay, let's say silver goes parabolic. I think we're gonna love that for a while, but then there has to come a point where we need to consider exiting. Your opinion, what would be the exit strategy for investors with regard to gold and silver?
There's a few ways. Let's say from the precious metals industry standpoint, in our view, you want to be owning a lot of the early stages or early discovery stories that there are out there. The businesses that are still drilling, they only have a property. They have results that can back up a good story of perhaps having a mine. And juniors in terms of the producers also look attractive. As you get into more of the late stages of this cycle of the bull market for precious metals, I view that you should be moving towards the royalty businesses and moving more towards the senior producers. I don't think we're there yet at all. Actually, it's almost like the same questions: when should we start looking at equities as a cheap way of purchases as an investment? I don't think we're there as well. In terms of silver versus gold, the exit strategy would be to move more towards gold and get out of silver as you get into the late stages of the cycle. When our macro models identify they were at the early stages of the business cycle, which is not the case at all right now, quite the opposite. But when that actually starts, it identifies that we're at the early stages, I think that's where you want to start owning more risk on assets. So you want to decrease your allocation towards precious metals and start buying things like stocks, like junk bonds. But it's not the case right now. That's how I view. I view more as a way of where you are in the business cycle. Are you late in the business cycle? Okay, well, that's time to own precious metals if they're cheap historically, or treasuries, or cash. And if your risk appetite allows you to go ahead and short stocks, well, that's another good strategy too. A lot of people disagree with that, but today I believe strongly this is one of those scenarios we're going to look back in history and say, wow, all these macro indicators are telling us that we should be shorting stocks, and no one's shorted. When are we ever going to short stocks? I mean, this is as good as it gets in terms of timing, in my view.
Okay, as good as it gets. We spoke a little on the coronavirus. Some guys they see it as a super bug pandemic type of a thing. Other guys they see it as nothing more than just the common flu. But in your view, and not a medical professional opinion, but in your view, how major of an impact will the COVID-19 virus have on the global economy?
Yeah, a lot. Number one is that it started at the worst place and worst time. And again, not that ever there is a right time and right place for a virus outbreak to happen, but it happened in China, and it happened at the largest credit bubble we've seen in history, at a time when consumers in China, it was holidays. Chinese population is a time of the year that they spend a lot of money. They were not able to do that this year because of the virus outbreak. Instead, we have the manufacturing plant of the world, which is China, shutting down completely, being completely halted in production, empty roads, no consumption whatsoever. And I think that's, if you remember, China was responsible for close to 60% of global GDP growth since the global financial crisis. It is a key driver of growth for the world. If that, which is the case, look at the PMI number that just came out, completely, it was awful, worst level since '08. So, that's an important point. Now we had South Korea outbreak, which is even more important from an economic perspective than even places like Italy, given its dependencies on electronics. The supply disruption of that would be big. And now we're seeing the number of cases growing exponentially globally, especially here in the U.S. and places like South America. Everyone's lying about the number of cases. And I think the markets are sort of ignoring the fact that we are not testing people in the U.S. When we start testing people for the virus, I think we're going to see the number of cases go exponential again. And remember that reflexivity idea from George Soros. That's very important. What we had in the beginning of the year was that prices were rising given the support from central banks and the reliance from investors on that. And the idea was that the prices increasing would increase collateral of investors in general, and that would boost credit growth again, and we would be in a soft landing scenario. That did not happen because one of the reasons was the virus. So that V-shaped recovery never happened. Only happened in the Fed balance sheet, as I said, and global central banks. It's important to know everyone is printing money pretty much. Look at gold in every other currency in the world. Against any other fiat currency, gold is rising, not falling. So I think that reflexivity thesis, everyone was seeing this distortion really between the prices rising in a big way. When you looked at the S&P 500 X energy, for instance, because energy has been such a dragger, it was one of the largest increases on a year-over-year basis in equity prices since '09, since '03, and since 1999. Guess what? We either are on the peak of the cycle or at the bottom of the cycle. Given all the macro indicators I just stated here in this interview, I believe that we're in the very peak of the cycle. This is 1999, not 2003, and not 2009. So I think that what's happening here is that the catch up from that divergence will be from the prices side and not from fundamentals. Fundamentals are probably only going to get worse going forward until we see real cracks in the labor market, and that's really going to mark the end of the cycle. We haven't seen that yet. Yeah. I believe that the probability of seeing the year-over-year change of unemployment rate, for instance, which is an incredible signal. Everyone thinks that unemployment is a lagging indicator, and they're right. But look at the year-over-year change of unemployment rate. When that starts to rise, watch out and look out below for equities.
Yeah. Touched on China as well. Do you think China comes back, or when they do come back, I should say, when China does come back, do you think they may not be the manufacturer of the world as much, where we may see manufacturing start to be more diverse in diverse locations?
Yeah, let's look at the sequence of facts. We had, first of all, the trade war. It scared a lot of companies that have manufacturing plants in China. and now we have the virus outbreak. It's giving, and then you have the labor costs rising in China. So there's a lot of reasons for companies to start looking for alternatives. Automation is very much against the Chinese economic model of today. How do you look at that? Well, you looked at the shrinking current account. The Chinese current account has been shrinking for some time now. It's close to 9 percentage points since the global financial crisis. That adds further pressure on their currency, number one. You had China having issues with the property developers. When you look at the property developers in China, they looked a lot like the home builders here in '07. They accumulated close to $700 billion of losses in free cash flow all the way back to '08. At the same time, they increased their net debt balance to close to $600 billion. So they're making no money, and they're just increasing the amount of debt. That has been the economic model in China for some time now. Close to 300% of banking assets to GDP, 400% normalized growth in banking assets in China. So, you can add up all these things, but what is really the problem in China that's going to cause the entire collapse? What is going to pop the bubble? Well, it's when cost of capital structure begins to rise. And there's two reasons for that. Number one would be inflation, which we're seeing in China. Looking at CPI numbers close to 5%. Food CPI caused by pork prices is close to 20% today. That's number from January. So that's still happening regardless of the virus situation. The virus is just adding to the case. The other part that we're seeing is defaults. That causes the cost of capital to rise. And we're seeing that already. The other issue, it forces China to just continue to ease. Look at 10-year yields in China relative to their CPI. So in real terms, Chinese 10-year yields is at its lowest level since 2008. That's another reason to own gold, by the way, in renminbi terms. I think that the Chinese currency will be the problem, will be the big consequence of all this debt buildup and all these imbalances that we see on the macro side of China. The Hong Kong crisis, in terms of political crisis, that never went away. The only pause is kind of not on the news right now because of the virus outbreak, but that's still the case. And money is running out of Hong Kong as well. I view this trade of being long gold in renminbi terms as an incredible opportunity. Why? First of all, the implied volatility of those currencies, regardless if it is the CNH, the offshore CNY, or the Hong Kong dollar, for instance, the China number 2, it's incredibly low. It's essentially the same thing as being long gold in dollar terms, right? But you get the asymmetry of the trade. What if the Hong Kong dollar depegs? And if it doesn't, you're still long gold in dollar terms. It's almost like a perfect trade in my view from a risk-reward perspective. Again, I don't know what's going to happen, but I think there's a high probability that the renminbi could devalue significantly and the Hong Kong dollar could devalue significantly. Look at deposits in Hong Kong banks are beginning to decelerate already. You have condo prices and home and real estate prices begin to fall in places like Hong Kong as well, which were in absurd levels. As we all know, even prior to or during the political crisis that was unfolding. The other sort of indicator you can see in China is emerging markets. Look at what's happening in emerging market currencies. It tends to precede large moves in CNY. When you look at, for instance, the JP Morgan has an index to look at emerging market currencies. It is at its worst level in history, and relative to renminbi or CNY USD, so the opposite everyone likes to see, USD CNY, is at its worst spread ever, which means, again, emerging markets outside of China are actually, or not including China, are actually already falling apart. Look at Brazilian real at its worst level in history in terms relative to the dollar. So this is a big deal. I believe that things are adding up. The macro trade of the century that we call, which is being long gold in renminbi terms and being short equities globally, is just starting to show as an idea that is starting to work out. So I think it's only going to continue to work, and I believe that it's an incredible opportunity for investors.
Tavi Costa, you're bringing the heat today, my man. Preach on. Good stuff. You got to let us know. How can our listeners know more about your work at Crescat Capital?
Well, at Crescat, we have a very open website. Shows a lot of what we do in terms of the funds that are available. We have a global macro fund, a long short fund, and also a precious metals SMA, or a separate managed account for almost anybody who would like to invest. And also we have a large cap that goes back to the 1999. It's a very long track record. Most of our funds have a very long track record, even the global macro fund. If anybody's interested, you can go to the crescat.net website and you can check everything you would like. We're very active on social media, especially, I guess, me. Kevin is getting more active as well, and especially on Twitter. We're always validating our thesis and showing what charts that we think that should be relevant for investors and everyone should be paying attention to. All of those charts should be pretty much in line with our views in the markets, and all of them have ideas, investment ideas that are related to our views. It's stipulated with those posts. So I'm always very active on LinkedIn, even Instagram now, and a little bit on YouTube. But I think the best way is just really look for in our website. If you type Crescat on Google, I'm sure you'll find us. And there's a lot of interviews and publications that we had, or letters. I read our letters. There's a lot there that really detail and more in-depth analysis of what we believe is going to happen, and we believe it's happening already.
Yeah, same. So completely agree. Tavi, my man, we thank you for the time you've given us today. You brought incredible amounts of information, and we're definitely going to do our best to send people your way. And just go to YouTube, Google Tavi Costa, Crescat Capital, Kevin Smith, and find everything that they're talking about, because these guys, I'm going to say it, they probably got the best info out there. So again, Tavi, we appreciate it a lot.
Patrick, thank you so much for having me again. It's a huge pleasure. I love your content as well. So always great to catch up with you, and great to be here again. Thank you so much.
All right. Thank you also, Tavi. Appreciate it. That was Tavi Costa from Crescat Capital. For more of his insights on the global economy, please visit www.crescatcapital.net. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content, and do also check out the SBTV podcast on iTunes and Spotify.